Buying real estate helps you save on taxes, and there's multiple reasons why, and one of them is the concept of depreciation. By using this concept, it's really a tax concept. Let's say you have a property and it's worth, $500,000. I'll try and make it a simple example. What you're allowed to do is, even though the value of this property is going up every year, you're allowed to take that initial purchase price, whatever the value is, and basically write the property down to zero over 27 and a half years, even though its value is actually going up. Now, when you think about it, it actually makes no sense, and I've never really figured out who came up with this law, but it's one of the most well-protected laws in the US in the sense that it's very unlikely to change. But you're basically taking the value of the property now that you bought it, and even though it's earning money, it's earning income all of the time, you're taking a portion of that value and you're basically putting into your taxes as a negative value. So on a $500,000 property, it might be $20,000 a year of negative taxation. And so what you're doing is you're using that to reduce the taxes that you should be paying because the property has income. And this is phenomenal. And it got even better. Over time, they added something known as bonus depreciation. And what bonus depreciation basically does is, instead of taking it over 27 and a half years, you can actually bunch up most, not all, but most of the depreciation in the first year of ownership. So bonus depreciation ebbs and flows. Right now, sort of it's reducing, and Congress is likely to bring back bonus depreciation next year. And that allows people to save an immense amount on taxes. And that's why I haven't sold those original properties that I bought in 2008 when they were pennies on the dollar. Because if I sold those properties, all that depreciation is going to get clawed back. So depreciation is not a tax benefit. It is a tax deferral. You're taking your taxes and you're pushing them out to the future. And when you sell the property, all those the benefits that you've taken, they get clawed back, which is why one of the things that protects real estate and why real estate values go up is people don't like selling real estate, because they know that the year that they sell real estate, well, they made a bunch of money from the sale, and then all of the depreciation gets clawed back, so they take a double hit, right? So it's a double whammy, and that is one of the reasons why people hold on to real estate for years and decades and longer than decades, because they really don't want to take that double hit when they sell real estate. So that's one reason why real estate saves people taxes. The other reason is most people that are holding real estate hold them in limited liability companies or LLCs. And once you put the real estate in an LLC, it's a company, it's a business. And so a huge number of new write-offs become available to you that are not normally available to most people. And if you truly know how to use those write-offs, talk to your CPA, talk to your accountant, you're going to get another set of tax benefits. And so I always like to say, it's not what you make, it's what you keep. And who would know that better than a California technologist, right? We get screwed over in 5 different ways on taxation from California. Our property taxes are insane, our sales taxes are insane, our state taxes are insane, and then we're in the highest federal tax bracket. I've actually paid 54% of my income in taxes in a given year. And the key message to people is, don't start being fixated on your top line. I earn $200,000 a year. I earn $300,000 a year. Stop saying that. Never say that again. Say, I kept $158,000 last year. I kept $144,000. That makes you data-driven, because you now know the bottom line, because the bottom line is the only money you can spend.